Every time crude oil prices rise by just $10 per barrel, inflation creeps up, the rupee weakens, stock markets react, and businesses feel the pressure almost instantly. But why? Why is one of the world's fastest growing economies so deeply tied to a single commodity? Today, we break it down with data, real examples, and what the future might look like. India consumes over 5 million barrels of oil every single day, yet it produces less than 20% of what it needs domestically. The rest, nearly 85%, is imported, paid for in US dollars. In 2023 alone, India's oil import bill crossed $250 billion. That is roughly 8% of GDP, just on oil. To put that in perspective, that is more than India's entire defense budget, multiplied 3 times over. When global crude prices rise, that import bill swells, and the pressure lands directly on the government, businesses, and consumers. Here's where it gets interesting for investors and business owners. Oil does not just power cars, it powers everything. Diesel moves every truck on Indian highways, carrying vegetables, cement, steel, and medicines. When diesel rises, freight costs rise, and that cost gets baked into the price of every product in the supply chain. Oil is also the raw material for fertilizers, plastics, paints, and chemicals. So sectors like FMCG, agriculture, and manufacturing take a hit on their input costs and margins. And then there is the currency effect. More oil imports means more dollar demand. More dollar demand weakens the rupee. A weaker rupee makes all imports, not just oil, more expensive. It is a compounding cycle. For the Reserve Bank of India, this rising inflation forces a difficult choice: raise interest rates to control prices, and higher rates slow down credit growth, corporate borrowing, and ultimately GDP growth. This is why a $10 rise in crude can trigger a broad market sell-off within days. Let us look at specific sectors that investors should watch closely when oil spikes. Aviation. Fuel accounts for 35 to 40% of an airline's operating cost. Indigo and Air India feel this immediately. Paints and chemicals. Companies like Asian Paints and Pidilite rely heavily on crude derivatives. Margins shrink fast. Logistics. Companies like Delivery and Blue Dart face direct diesel cost pressure. Oil marketing companies, that is BPCL, HPCL, and Indian Oil, are caught in the middle. They buy crude at global prices but often cannot raise pump prices freely, squeezing their margins. On the flip side, upstream producers like ONGC and Oil India can actually benefit from higher crude prices since they sell at global rates. Understanding this sector map can help investors rotate smartly during oil shocks. Now, is India doing anything about this structural vulnerability? Yes, and the progress is real, though gradual. India has committed to 20% ethanol blending in petrol by 2025, reducing crude demand in the transport sector. Early results are promising. The electric vehicle transition is accelerating. Two-wheeler EV sales crossed 1 million units in financial year 2024. As the EV fleet scales, petrol demand will structurally decline over the next decade. India is also aggressively expanding renewable energy, targeting 500 gigawatts by 2030, which reduces oil dependency in power generation. And investments in strategic petroleum reserves, underground storage in Mangalore, Padur, and Vishakhapatnam give India a buffer of roughly 9 days of consumption during supply shocks. These are not overnight fixes, but they are directionally correct and worth watching as long-term investment themes. India's oil dependency is not a flaw. It is a reflection of a rapidly growing economy that has not yet fully built its energy alternatives. But for investors and business people, understanding this dependency is essential. It explains inflation cycles, currency movements, sector rotations, and Reserve Bank of India policy decisions all at once. The investors who track crude oil alongside their portfolios will always have an edge. If you found this breakdown useful, like this video, subscribe, and hit the bell icon. See you in the next one.